Welcome to Line of Sight, Clearway Capital Solutions podcast series, where we talk to service providers, stakeholders and industry bodies that can assist fund managers and general partners in building their businesses in Australia and New Zealand. This podcast is for educational and illustrative purposes only and does not constitute and should not be relied upon as financial advice. The podcast will be provided to listeners on the basis that they are wholesale investors only within the meaning of the relevant sections of the Corporations Act.
In this episode, Line of Sight talks with Toby Potter, Chair of the Institute of Managed Account Professionals, IMAP, an industry organisation for advisors, managers, providers and other businesses actively involved in offering or supporting managed accounts. Toby and Cameron Harris, Business Development Manager from Clearway Capital Solutions, discuss how managed accounts have become the fastest growing segment in wealth in Australia and what this means for fund managers and GPs approaching the managed account market in Australia.
Hi Toby, thanks for joining us today.
No, it's a pleasure to be here, Cameron, and to talk about something that I'm vitally interested in.
No doubt. All right, well, let's start right at the beginning. In the Australian context, what are managed accounts?
Well, really they divide up into two types of managed account. SMAs, which are registered managed investment schemes, that they're effectively a unit trust without a unit price, and managed discretionary accounts, which are technically unregistered schemes, but in reality are agreement or contract-based arrangements for discretionary portfolio management. In the retail market, they're both designed to operate substantially similarly for portfolios to be managed by a professional portfolio manager to meet an investment objective, which is set out either in the PDS for SMAs or in the investment program for MDAs. Once you start to get to wholesale, and I'm sure we'll talk a little about that later on, once you start to get to wholesale, then SMAs become much less significant. MDAs really come into their own.
Okay. And to give us some context around quantum, how large is the managed accounts sector in Australia and which segments in that have grown the fastest?
Look, as part of my IMAP role, we collect data on the managed account market, and I've been doing that since about 2019. So they've grown in that time from about $50 billion to the last survey we did in December 2024, where they were about $232 billion. We're doing those surveys twice yearly, so we're right in the middle of the June survey now. So what we've seen is, growth rates over the last 3 or 4 years in excess of 20% per annum, because it came off such a low base in 2018, 19. The growth rates since then are sort of unrepresentative, and I can't see any reason why this growth rate of 20% plus per annum won't be sustained. In fact, when GDG recently acquired Evidentia, they predicted a market by 2027 of about $450 billion for managed accounts. So to put that in context, managed accounts are part of the advice market. So they're really developed by and for advice businesses, whereas managed funds are part of the investment management business developed by, investment managers. It's a tautology almost. So the thing which really significant is that the platforms have climbed into the SMA market pretty aggressively in the last 5 years. And SMAs have now come to dominate the managed account market at just under $150 billion in December. MDA growth has been a little slower It's between $50 and $60 billion now. And there is there's always an other. So there's, there are some other forms of discretionary portfolio management which we measure. MDAs, or sorry, managed accounts have been pretty widely adopted. And nearly 60% of advisors now say that they make some use of managed accounts. But I want to put it in the context of the advice market, which, as far as I can tell, is sort of $1.5 trillion, so $1,500 billion. So we're really talking about managed accounts currently being about 15% of the advice market. So there's clearly a long way to go when you've got nearly 60% of advisors making some use of managed accounts, but FUM is only 15% of advised FUM. Clearly this is a market that is going to continue to grow pretty strongly over the next 3, 4, 5 years. There's no reason why managed accounts shouldn't be 50% of the total advised market. The benefits for investors and for advisors are overwhelming, and we'll talk about those benefits later.
Yeah, thanks, Toby. It's undoubtedly managed accounts are firmly entrenched as a key pillar of the advice market, undoubtedly. So, well, let's pick that apart a little bit more. So, from your perspective, which investor segments have contributed to that growth over the recent period you refer to?
Well, look, the early adopters were some selected higher net worth advice businesses, and probably, like all early markets, a few true believers, a few people who were kind of deliberately entrepreneurial. Once the platforms recognised the opportunities that SMAs provided to them, then you started to see mass market adoption by advisors, and I mean mass advisor market adoption rather than mass retail market. And we're currently right in the middle of that phase of the market now. And ironically, we're now starting to see the high net worth family office private banking market start to come back in as the technology develops, and as they get out of the mindset of I'm an advisor, I do that stuff, my clients don't want to feel as though they've lost control. But we're starting to get through that in the seriously high net worth family office market. The market, and apart from anything else, technology is now starting to make it possible for private market assets to be adopted into MDA type structures.
Mm-hmm.
So, I mean, Cameron, you, from your perspective as somebody involved in the investment management side, I mean, when you look at the managed account market, what do you see the sort of groups that you engage with using managed accounts to solve?
Yeah, it's a good question, Toby. Correct. We're at the coalface, talking with asset consultants and advice professionals, day in, day out. And there's probably 6 challenges that managed accounts tend to address. The first problem or challenge is that managed accounts enable customization versus pool vehicles. And that tends to align much better with an individual's goals, tax and risk preferences. Secondly, it really allows for much more tax efficient strategies. You think about things like tax loss harvesting, particularly for high net worth clients where that's a real key part of their advice. Transparency is really key. Visibility is so important to a lot of clients. We find that managed accounts tends to fill a gap there in terms of providing a lot more transparency. Flexibility in contributions and withdrawals without impacting other investors is key, and probably one of the main issues that it's solved for since day one. Estate planning and values-based investing, such as ESG and ethical overlays, can be incorporated a lot easier in a managed account. And finally, for certainly high net worth advice firms, it tends to help advisors mitigate generic one-size-fits-all approach for managed funds and ETFs. So pretty broad range of problems that managed accounts address, and I think that's going to continue to grow as it forms a key part of the industry. Toby?
Yeah, and look, I think there've been a couple of recent developments in retail financial services, and I mean very recent. Division 296, this $3 million issue, is particularly for MDAs going to be quite a significant driver, because high net worth clients, the people with over 3 million in retirement oriented assets, are going to end up having to split their assets between super and non-super. And an MDA structure like the one that we at Philo are involved with can accommodate that multi-entity structure. And the other thing, which I think will have a indirect but material impact, is the experience of Shield and First Guardian and the loss of $1 billion of retail investor money, leading ASIC to turn around and go, hang on, we've got to have more control over what individual advisors are doing. And managed accounts will be one of the vehicles that I think they adopt for that. So thinking about those sort of wholesale investors, the high net worth investors, Cameron, how do you, as you deal with family offices, how do you see them sort of starting to access managed accounts?
Yeah, it's certainly growing, Toby. And I think traditionally, as you said earlier in this conversation, the platforms were the ones that were really quick to adopt managed accounts, as they saw this is a key part of how they can grow what they offer to clients. So absolutely, platforms is probably the key one. And within that, advisors can set up SMAs, MDAs and hybrids tailored to client needs. We're also seeing private banks offering curated SMAs to high net worth clients using established models, and whether that may well be on their own proprietary software as well. But certainly private banks have adopted it much more recently as well. There's been a growth of, as you know, licensed MDA providers, which, and we'll get to sort of the definitions of the different types of managed accounts, but allows full discretion under tailored mandates, something that historically was only available to quite high net worth clients. We're seeing is being opened up to a lot more investors. A growing space, multifamily offices and private investment offices, we're seeing use MDAs and IMAs for their clients. And again, like my point before, IMAs tend to offer the most customization, whether that's including ESG alternatives, semi-liquid assets, tax strategies, and flexibility around custody. So it's certainly a growing space for people to be able to access managed accounts in the market. So we've talked about SMAs, MDAs, IMAs. Toby, could you provide a bit of a key differences between the three of those areas?
Yeah, look, I think it's good because it's not well understood. So there's a lot of jargon in this. So SMAs, separately managed accounts, it's not a legal term, but typically they are, as I said right at the start, registered managed investment schemes offered with a PDS as a product. And one of the key points about them is they are platform specific. So whereas a managed account is sort of fungible between platforms, a unit trust is the same on every platform. SMAs are unique to each platform. The Macquarie series, that's only available on Macquarie. The Netwealth series, only available on Netwealth. MDAs, as I said at the start, it's a contractual arrangement. It's technically an unregistered scheme. And there's an investment program which says how the portfolio is going to be managed. But in reality, almost all of them are run as models with more or less extensive customization for each client. Then IMAs that you just talked about, Cameron, that's, again, it's sort of jargon, but it reflects the reality of high net worth clients who typically have more complex structures or have assets that need to be taken into account that aren't part of the model but should influence the way the model's managed. So it's a non-technical but extremely useful term. They're all subject to ASIC regulation, of course. SMAs through the Corporations Act, just as any other registered scheme is. MDAs through their own bit of regulation, the legislative instrument, which specifically sets out how they're offered to retail clients. So, look, I guess you guys deal with super funds quite a bit more, perhaps, than I do. How do you see the sort of competition between those institutional mass market funds, the industry funds, and the sort of emergence of managed accounts in the advice space, Cameron?
Yeah, it's a good question, Toby. I mean, look, institutional supers, they still have scale, very low cost and embedded services such as, insurance and governance, etc. But undoubtedly, managed accounts are increasingly competing with the super funds. And that's particular for, the high net worth SMSF and advised clients space where they're seeking a lot more control and transparency. As we talked about before, managed accounts offer tailored tax strategies, while super funds tend to focus on their pooled efficiencies. As you say, it's about scale, etc. Another interesting point also was around the FOFA reforms, which prompted advisors to move clients from MySuper to managed accounts. And platforms undoubtedly have really enhanced investor access to managed accounts, reducing institutional sort of super dominance. What's really interesting also is around retirement income strategies. The domain of the big supers, but you're seeing that they can often be a lot better optimised via managed accounts as well. So I think as a conclusion at this point, it's watch this space.
Look, that retirement thing is it's clearly a point of pain for the industry funds as APRA is starting to say, you've got to have a retirement strategy, but there's more variation at an investor level in the retirement area than in the accumulation area. So what do you see as the sort of from the fund managers that you represent or deal with? What do you see as the sort of opportunities for them in the managed account space? You'd be dealing with quite a number of fund managers and general partners. What do you see as the opportunity that managed accounts bring for them?
Yeah, we're seeing this play out, as you mentioned, with the size of the industry. And certainly for those GPs offshore, etc., it can present a significant new distribution channel. And if the strategy is true to label, it can provide pretty sizable sticky capital for fund managers. Entry into managed account models are pretty binary, as you know. You're either in or you're not. So once you're in there, and as I said, you're true to label, it can be a pretty substantial source of capital for GPs. As we know, the advisor landscape is significantly fragmented, complicating distribution. There's we think about 100 plus SMA managers, 250 MDA providers. You know, if you're a large GP that is traditionally focused on its institutional investors, how are you going to have the distribution reach to be able to access those pools of capital? So, accessing it via managed accounts is almost a quasi-institutional way of accessing capital without having the need for big distributions teams, et cetera, et cetera. One thing GPs need to be aware of is the expectation of institutional pricing, albeit at a retail scale, and so that can really compress margins as well. Undoubtedly, there is opportunity for GPs in this space, but it does require significant operational and technological readiness to be able to plug into them.
And I think, look, to pick up on that point about institutional pricing, although I don't think prices have necessarily got quite down to the industry fund level, there's no question that the control that it gives the consultants, the portfolio managers, has led to pricing pressure. I mean, when you deal with consultants, I mean, what's your experience of engaging with them?
Well, certainly, you know, you can slice the consultant landscape into two areas. You've got the institutional consultants, then you've got the wealth advice consultants. 15, 20 years ago in wealth, you might have had 5, 10 boutique asset consultants, and now there's probably around 30 to 50. So the ecosystem is more fragmented and complex, by a factor than the institutional consulting space. So again, it's expertise on the ground. How do you access those 30 to 50 asset consultants? They have significant influence around vast pools of capital. So it's a really evolved space. I think that the conclusion is there. The institutional consultants, they increasingly are also moving into the wealth advice space as well, and they're seeing the value of incorporating separately managed accounts. We're seeing them move into private banks, even ETF issuers. That's been a really big increase in where asset consultants have been playing in the last couple of years. And the way they engage with their advice firms can vary. You'll see some consultants will actually sit on investment committees, and they'll have a casting vote on what can go in and out of a managed account. Some will deliver purely just a product-focused solution. And some also, in addition to this, specialise, in ESG and sustainability, advisory and model construction. So the point around this is it's really important to be fully across the evolution of the consultant space, both in the wholesale wealth space and also the institutional space, because it's absolutely fragmenting more and more.
Yeah, look, I think that's absolutely right. Yes, accompanying the growth in the managed account market has been the growth in the consulting market, and you touched on the significance of the ETF issuers. That's putting a real price floor or price ceiling probably around the sort of the cost of portfolio management as the BlackRocks, the State Streets, Vanguards, beta shares climb into this market with vigor. So in that context, then, what if you're a fund manager from offshore thinking about this market? I mean, what would you be? How would you be approaching it?
Yeah, think of it, or the way I like to think of it, as a bit of a playbook. You've got 6 key points that GPs need to really consider. And we've touched on this in the previous few points, Toby, but the first one is really about the imperative to develop relationships with the key players. So who are they? Model managers, advisory groups, platforms, asset consultants. And that takes a long time to develop that expertise and knowledge base. We talked about tech before, so the need to support transparent data sharing and handle platform integration. I think more than ever, that's actually probably one of the key points in all of this is you've got to get your tech right to be able to feed your data through to the various providers that need it. whether it's for execution or reporting. That's pretty key. GPs really need to be able to tailor their onboarding processes to the varied consultant requirements. We heard there's 30 up to 50 consultants, 50 different type ways of potentially onboarding clients. A really key part is to have flexibility around the legal structures. The preferable vehicles in Australia are unit trusts, and they tend to be via information memorandum. So yes, ICAVs, etc., can be used. There needs to be some expertise around being able to deliver different legal structures according to the managed account. Every consultant's different. So again, expertise around understanding the different consultant styles and being able to adapt accordingly. And from what we see, and part of what we do at Clearway, is that building internal capabilities is crucial, and that means around client servicing and reporting specific to managed accounts. That's a pretty key one as well.
Yeah.
So
I think the point you made, the point you made earlier, Cameron, about the importance of strong data is, I'm living this at the moment through Philo, where we're switching data providers from Clearstream to LSEG, and just having timely data on the hundreds of funds that are in the managed accounts we run, the MDAs that we run, is something that this kind of transition period is giving us a bit of grief about. It's critical. So, I think those points that you made are excellent.
We've talked about what offshore GPs need to be aware of when entering the managed account market in Australia. How do Australian managed accounts differ from offshore? For example, the US, Toby.
Yeah, look, it's a good point, and the fact that the terminology is the same disguises the really significant differences. And I think one of the key things is you've got to understand the role of the platforms in this market. That platforms are dominant in the retail advice market. They're between them collectively, they're over $1 trillion, over $1,000 billion. So whereas my understanding is that in the US, managed accounts held individually, and they typically prioritize customization and tax management. Some of those tax management tools are not available as a result of tax law in Australia. So tax harvesting, for example, not available. The amounts of money involved are such that direct indexing, for example, just not an issue in this market. There's no direct to retail market for managed accounts here. It is a solidly advisor based market. So if you're offshore and coming to Australia and thinking about managed accounts, you've got to remember that it is platform driven, that the platforms have got a strong vested interest in SMAs as a vehicle for FUM acquisition for themselves. MDAs run on platform, but a much more diverse set of operating structures. US strategies probably need to be, repackaged through local vehicles to meet the sort of regulatory requirements in this market.
You've touched on product design there, Toby. So in Australia, we've seen a significant move towards private assets or private markets. And I know that there's been a lot of demand for managed account providers to solve for the inclusion of semi-liquid assets within their managed accounts. Are you seeing less liquid strategies being integrated into managed accounts?
Probably back to the point I made earlier about the significance of the platforms. Platforms generally have a bit of difficulty accommodating, genuinely illiquid products, and so we're not seeing the sort of closed-ended funds or genuinely illiquid products used through managed accounts. So what we're starting to see now are vehicles that create liquidity through cash holdings or through other structures, being a way for which managed account investors can get the benefit of less liquid underlying investments. SMAs are trying pretty hard to accommodate less liquid investments, but it's probably true that MDAs are much. It's a structure that just lends itself much better to creating to accommodating illiquid assets. We've got one high net worth practice which is explicitly including an illiquid sleeve within their MDA because they've got a client base that can deal with exposure to illiquidity, and so I for those managers who've got underlying illiquid investments, the real assets, the infrastructure, MDAs and the sort of high net worth market's probably going to be the preferred vehicle.
As part of your role at IMAP, you certainly fly the flag like no other in this country, but playing devil's advocate from my perspective, do you think there's a concern that the managed account sector is conflicted in any way?
Look, well, ASIC, as recently as last week, released a new set of draft guidance on the management of conflicts, RG 181, which they haven't updated since 2004. And I had the pleasure of reading that earlier this week. It's all good motherhood stuff, and in itself, there's not a lot in the revised conflict of interest policy that you could take exception to. There's the potential for conflict in the managed account market because, as you observed earlier on, Cameron, quite a number of the portfolio managers are either also advisors or are related parties of the advice network. So there is the potential for conflict, for explicit conflicts in a revenue sense, or for conflict of process, if you like. I prefer this managed account structure, which we've got an involvement in, because it makes my life easier. What we're doing in IMAP, and I think the key focus for confronting the issue of conflicts of interest is to prove the client benefits that managed accounts bring. And there is absolutely no doubt in my mind that clients get a better outcome from professionally managed portfolios than they do from the sort of, I won't say arbitrary portfolios that advisors construct, but from portfolios that advisors are just simply less capable of constructing in a professional manner than a professional portfolio manager would. And the other thing which they create, of course, is a good deal of transparency and evidence of governance. And the role of both the responsible entities of an SMA or the MDA provider in MDAs is to ensure through the fiduciary duties that both of them have that governance is in place and is applied in a real sense. So yes, there's the potential for conflict of interests. Has it been evidenced? No, not to my knowledge, but it's an issue which I think is going to get more attention, and to deal with it, we're going to have to explicitly identify the consumer benefits that come from this type of vehicle.
Look, Toby, it's been fascinating talking with you this morning. Sadly, I think we're just about run out of time, but this is a space that has grown substantially. It's such a key part of our industry, so it's been really interesting talking to you about it. I want to thank you for your time, and we'll see you next time. Thanks, Toby.
Thanks very much, Cameron. Nice to talk to you.